Right now, as you are watching this, the United States military has fired more than 2,000 precision-guided munitions into Iran in just 8 days. Each Tomahawk cruise missile contains between 10 and 15 ounces of silver. Each interceptor missile uses silver in its guidance systems, its circuit boards, its soldering, and while those missiles are burning silver out of existence at a rate we have not seen since the Gulf War, the COMEX exchange, the place that sets the price of your silver, just reported that registered inventory has fallen below 88 million ounces. That is an 80% decline from the 2021 peak, and I have not seen a single mainstream financial outlet connect these two facts together. Not one. Welcome to the channel. If this is your first time here, I cut through the noise and show you what is actually happening in the gold and silver markets while everyone else is distracted by headlines. Subscribe right now because what I am about to walk you through is not on any mainstream financial channel, and it could fundamentally change how you think about your position in precious metals over the next 30 days. Now, if you watched my video last week, my urgent gold and silver wartime analysis, you know I laid out the case for why this Iran conflict raises the floor on gold to somewhere between $4,900 and $5,000 an ounce, and why silver's technical breakout above $92 before the war started was significant. But here is what I did not have time to get into, and frankly what I have spent the last week researching. There are three things happening simultaneously right now that almost nobody is putting together. The first is the war's direct impact on physical silver supply. The second is what the COMEX vault data is screaming at us, if you know how to read it. And the third, and this might be the most important one, is what the March 18th Federal Reserve meeting could do to metals prices depending on what happens with oil-driven inflation between now and then. Stay with me on that last one because it is the piece that could either send silver to $100 or temporarily pull it back to the low 70s, and I need you to understand both scenarios. Let me start with the war math, because this is the part that genuinely blew my mind when I sat down and ran the numbers. As of today, March 8th, 2026, Operation Epic Fury is 8 days old. According to Admiral Brad Cooper, the head of US Central Command, the United States has struck nearly 2,000 Iranian targets with more than 2,000 munitions. On the other side, Iran has fired over 500 ballistic missiles and almost 2,000 drones since February 28th. Now here is what matters for you as a silver holder or potential buyer. A single Tomahawk cruise missile uses roughly 12 to 15 ounces of silver in its electronic guidance systems, its circuit boards, and its internal wiring. A Patriot interceptor uses silver. A Thada interceptor uses silver. The SM-3 and SM-6 naval interceptors being fired from destroyers in the Gulf use silver. Shahed drones use silver. Even the soldering in the circuit boards of every single piece of military communications equipment being deployed right now requires silver. Let me put this in perspective. According to CNN, the United States used up to 20% of its SM-3 interceptors and between 20 and 50% of its THAAD missile inventory during just the 12-day war with Israel and Iran back in June of 2025. Now we are in week 2 of an even larger conflict, and the Pentagon is already scrambling to meet with Lockheed Martin, RTX, and L3 Harris this week to discuss ramping up interceptor production. But here is the critical point. You cannot ramp up interceptor production without silver. Silver is not optional in these weapon systems. It is essential for the conductivity, the thermal management, and the reliability of guidance electronics at hypersonic speeds, and every single missile that gets fired is silver that is gone forever. It is not recycled. It is not recovered. It is vaporized on impact. Now, I want you to hold that thought, because here is where it connects to what is happening at the COMEX. As of March 5th, 2026, registered silver on the COMEX, and when I say registered, I mean the silver that is actually available for delivery against futures contracts, not just sitting in a vault, has fallen to approximately 86 million ounces. Let me say that again, because I need you to understand the magnitude of this. 86 million ounces, that is it. That is all the deliverable silver backing the largest precious metals futures exchange in the world. Now, to put that number in context, in 2021, registered silver on the COMEX stood at over 400 million ounces. We have seen an 80% drawdown in deliverable silver in less than 5 years, and the pace is accelerating. In the last 30 days alone, registered silver has seen net outflows of over 22 million ounces, and total COMEX silver inventory has declined by over 56 million ounces. Metal is not just being reclassified from registered to eligible, it is leaving the vault entirely. Think about what that means. Someone is taking physical delivery and removing it from the system. And here is the number that should genuinely concern you if you are sitting on the sidelines. The COMEX Stress Index, which combines the coverage ratio, inventory trend, paper leverage, and vault outflows into a single score, currently sits at 81 out of 100. The all-time high is 88. We are within 7 points of the most stressed the COMEX has ever been. The paper to physical ratio stands at 6.9 to 1. That means for every ounce of deliverable silver in the vault, there are almost 7 ounces of paper claims outstanding. If you understand fractional reserve banking, you understand why that matters. If even a small percentage of those paper holders stand for delivery simultaneously, the math does not work. And if you want to see how serious the delivery demand has become, look at what just happened in February and March. In February 2026, 5,036 contracts were delivered. That is over 25 million ounces in a minor delivery month, the highest February delivery volume in modern COMEX history. And in March, 10,526 contracts are standing for delivery. That is over 52 million ounces of delivery demand against 86 million ounces of registered inventory. Let me put that differently. March delivery demand alone represents more than 61% of the entire registered silver inventory on the exchange. Are you paying attention? Now here is where I have to give you the other side of this. And this is the part most silver channels will not tell you because it complicates the narrative. The biggest short-term risk to gold and silver prices right now is not the war. The war is actually bullish for metals. The biggest risk is what this war is doing to oil prices and what oil prices are doing to the inflation picture heading into the Federal Reserve's March 18th interest rate decision. Think about this. Gold is currently trading at approximately $5,185 an ounce. Silver is at approximately $85 an ounce. The gold to silver ratio sits at roughly 60.8 to 1, which is historically elevated and suggests silver has significant room to outperform if the ratio reverts toward its historical median of 50 to 1. But here is the problem. Crude oil just had its biggest weekly surge since Russia's 2022 invasion of Ukraine. Iran is striking Gulf oil infrastructure. Flights in and out of Dubai have been grounded, which is disrupting physical bullion supply chains. And all of this is pumping energy costs higher, which feeds directly into inflation data. Now, why does that matter? Because the Federal Reserve meets on March 18th. That is 10 days from now. And the market is widely expecting the Fed to hold rates steady at that meeting. But what matters is not just the decision. It is the language. It is the dot plot. It is whether Jerome Powell signals that rate cuts are being pushed further out because inflation from this oil shock is re-accelerating. Remember what I told you in my last video, the market was pricing in a 74% probability of 2 to 3 rate cuts by December 2026. That probability is already falling. Bloomberg reported that markets now expect a potential rate cut by September at the earliest, pushed back from earlier projections. If Powell comes out on March 18th and signals that rate cuts are off the table for the first half of 2026 because of rising energy-driven inflation, the dollar index will spike, and when the dollar spikes, gold and silver face short-term selling pressure. We saw this exact scenario play out in October of last year, when Powell made hawkish comments and both gold and silver pulled back. Now, I am not telling you this to scare you. I am telling you this because I want you to be prepared. not surprised. And here is the critical difference between October and now. In October, the COMEX had significantly more registered silver. Central bank buying had not yet hit 2026 levels. The war was not happening, and industrial demand from solar, from AI data centers, and from electric vehicles had not yet reached the levels we see today. According to the Silver Institute and Oxford Economics, industrial silver demand is poised to grow significantly through 2030, driven by solar photovoltaics, electric vehicles, and artificial intelligence data center buildouts. In 2014, only 11% of industrial silver demand came from solar. By 2024, that number had risen to 29%, and even with manufacturers trying to reduce silver content per cell, the sheer volume of global solar installations is overwhelming those efficiency gains. The European Union alone is targeting 700 gigawatts of solar capacity by 2030. Each gigawatt requires millions of ounces of silver. And now we have an entirely new demand category that barely existed 3 years ago: AI data centers. The total IT power capacity worldwide has grown from just under 1 gigawatt in 2000 to almost 50 gigawatts in 2025. That is a 5,000% increase. And every server, every connector, every high-frequency component in those data centers uses silver. So let me bring all of this together for you, because this is the part that changes everything. The silver market has been in a structural supply deficit for 6 consecutive years. The Silver Institute forecasts a 67 million ounce deficit again in 2026. Annual mine production sits at roughly 830 million ounces. Annual demand exceeds 1 billion ounces, and 72% of primary silver production comes as a byproduct of mining other metals, which means production cannot simply scale up when prices rise. You cannot just turn on a silver mine. It takes 7 to 10 years to bring new silver supply online. Now layer on top of that deficit everything I just told you: military consumption destroying silver at unprecedented rates, COMEX registered inventory at 80% below its 2021 peak, delivery demand running at 61% of remaining registered stock in a single month, China tightening silver export licenses since January 2026, further squeezing global physical supply, Shanghai gold exchange premiums holding firm while Western paper prices fluctuate, and industrial demand growing from solar, EVs, and AI that cannot be substituted away from silver because no other element matches its electrical and thermal conductivity properties. If you learned something new from that breakdown, hit that like button right now. It helps more people see this. And honestly, this is the kind of information that should be on every financial channel, but is not. Now let me give you the math on $100 silver, because I know that is what many of you want to hear. And I want to be responsible about this, so let me frame it as analysis, not advice. Silver hit its all-time nominal high of $121.67 on January 29th. It has since pulled back to the mid-80s. That is roughly a 30% correction. But consider this: if the gold to silver ratio reverts from its current 60-1 toward its historical average of 50-1, with gold at $5,185, silver would need to be at $103.70. That is not a fantasy number, that is just ratio reversion math. And if gold continues its trajectory toward the $6,000 to $7,000 range that multiple analyst models project for the second half of 2026, a 50-1 ratio puts silver between $120 and $140. But here is my honest assessment, and I need you to hear this. The path to $100 silver is not a straight line. The March 18th Fed meeting is a genuine risk event. If oil-driven inflation forces the Fed to delay rate cuts, we could see a temporary pullback to the mid-70s or even the low 70s on silver. If that happens, and I am telling you this as someone who is personally bullish on metals, that is not a reason to panic. That is a reason to accumulate, because the fundamental picture I just laid out for you does not change based on what Jerome Powell says at a press conference. Physical reality always wins. The question is not if, the question is when. Let me ask you something. Comment below with your realistic silver price target for the end of 2026. I want to see where this community stands. And tell me, are you more concerned about the Fed meeting or the COMEX vault drain? Drop Fed or COMEX in the comments so we can see the split. Now, I want to close with something I think about a lot and I hope it resonates with you. There are 3 types of people watching this video right now. The first type is looking at the pullback from $121 to $85, and they are scared, they bought near the top, they are underwater, and they are thinking about selling. The second type is frozen. They have been waiting to buy for months, maybe years. They see the data, they understand the thesis, but they cannot pull the trigger because they keep waiting for the perfect entry point that never comes. And the third type understands something fundamental. They understand that you do not buy silver for where it is today. You buy silver for where fiat currencies, supply deficits, and industrial demand are taking it over the next 3 to 5 years. They understand that $85 silver with registered COMEX inventory at 86 million ounces, with 6 consecutive years of supply deficits, with the largest military conflict in the Middle East since 2003 burning through physical silver every single day, is not expensive. It is early. Which type are you? Tell me in the comments. If this video opened your eyes to something you had not considered before, share it with one person you care about who needs to understand what is actually happening in the silver market right now. They are not going to hear this on mainstream financial media. Subscribe to this channel for daily gold and silver analysis that goes beyond the headlines and into the data. Hit that notification bell so you do not miss what comes next, because the March 18th Fed meeting is 10 days away, and I will be covering every development that impacts your metals position between now and then. Every source I referenced in this video is linked in the description below. This is not financial advice, this is education. Every individual must assess their own circumstances, risk tolerance, and investment objectives before making any financial decisions. I will see you in the next video. Take care of yourselves, take care of each other, and stay sharp out there.